Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to Fundamentals, our regular look at the world of funds and collectives, where we highlight one of the most popular purchases on the AJ Bell Invest Centre platform, and then analyse why advisors and clients might be buying right now. This week, nestled towards the bottom of the top 10 for passively run funds, is iShares Sterling Corporate Bond 0 to 5 year ETF, or Exchange Traded Fund. Now, an ETF is designed to track or mirror the performance of the underlying assets and deliver that performance minus any running costs. In this case, iShares Sterling Corporate Bond 0 to 5 year uses physical or direct replication to provide performance. It looks to mirror a sterling corporate bond index run by Market iBox, and it owns the underlying securities to do so. In this case, the investments are sterling denominated bonds issued by companies that have up to 5 years to maturity and are investment grade. Top holdings include paper issued by Swiss bank UBS, German utility E.On and the UK's HSBC. Now, the ETF comes with an ongoing charge figure of 0.2% and a 12-month yield of around 2.9%. It's SIPP and ISA eligible, but note that the ETF units trade at the moment at around £105 a piece, which is a bit chunky, so be careful for your financial planning there. As a final point, iShares Sterling Corporate Bond 0 to 5 year began trading in 2011 as a 3-star Morningstar ranking and £725 million in assets under management. The graphic shows how the ETF has performed since launch. So, that's the mechanics. The question now is, why would advisors and clients be potentially buying now? Well, to my mind, there are 3 possibilities. 1, the ongoing search for yield, a topic we've addressed several times, I know. A 2.9% yield beats cash and 10-year gilts hands down, albeit in exchange for a bit more risk, but that risk is partly mitigated by the focus on investment-grade debt. Here's the 10-year gilt yield over the past year as a reference, 1.84% as I sit here right now. 2, the focus on sterling-denominated bonds. The pound's currently weak against the dollar, strong against the euro, but as former Governor of the Bank of England Mervyn King once implied, second-guessing the currency market's a mug's game. The sterling-priced angle at least leaves advisors and clients with one less thing to worry about. You don't have to fret about the forex markets. 3, it's a short duration fund, a focus on bonds that have a maturity of 5 years or less. This provides some capital protection against any rise in interest rates while still allowing clients to seek income. Now remember, duration measures how much a bond's price moves relative to a change in interest rates, and that bond prices tend to fall as rates rise and vice versa. This means that, as a rule of thumb, longer dated bonds have longer durations as their returns are more back-end loaded and the price will be more volatile or sensitive to interest rate movements. Lower coupon bonds will have longer durations as well and therefore also be more volatile as again the returns are more back-end loaded. The opposite also applies, so the shorter the life of the bond or the higher the yield, the shorter the duration. Now in this case, the ETF's portfolio has an effective duration of just 2.35 years, something which may appeal to clients who are looking for fairly dependable income but want some shelter should rates start to rise, which they just might in the USA on December the 16th if the Federal Reserve finally takes any action. Do note from the previous chart though that the ETF has lost a little ground of late as the market's prepared itself for the possibility of higher rates. So it may not be entirely immune to any bond market turbulence if the Fed does make a decisive move. As for the current portfolio, the underlying, well, there's an 11.5% cash weighting, which is perhaps an added buffer. And in terms of geographic exposure, the UK is the largest weighting, as his final graphic shows. At nearly 46% of assets, it's way above everywhere else, 14% for the States, 9% for Germany, and 5% for France. Thank you for watching, and I look forward to seeing you next time.